Hi, in today's lecture, we're going to learn about demystifying the numbers. What is accounting? Accounting is the measurement, processing, and communications of information about a business or corporation. In a nutshell, there are two kinds of information transfer. Financial accounting for outside entities like banks, shareholders, etc., and managerial accounting for internal decision making. The purpose of this section is to familiarize ourselves with the three kinds of financial statements. You will learn more about in detail about these documentation which form the benchmark of accounting. The first one is balance sheet, the second is income statement, and finally the cash flow statement. Balance sheet. We can divide a balance sheet into assets, liabilities, and shareholders' equity. A minus L equals E, where A is the asset, is everything that the company owns that is useful and may lead to future benefits. Liabilities, which is L, are things that are taken out that are taking out money from the business, like bank installments, supply credits, etc. The remaining net is counted in shareholders' equity, E. It is whatever is left with you as a stakeholder, removing liabilities from your assets. We sometimes see that assets and liabilities are mentioned as either short-term or long-term. There are examples for in example of a cat cafe, for example. What do you think? The cats in the cat cafe are an asset or a liability? They're neither. They're not an asset either, because usually these cats belong to a nearby shelter and are not considered as an asset for the company. Here's an example of an asset of the balance sheet of a company, where you can see assets on the left side, and then liabilities and shareholders' equity on the right side, in divided into sections. Here's another example for Amazon. You can read this document in detail to get a better idea. Income statement shows us two main things: what revenue has the business made over the certain period of time, and what expenses have been flowing out during this period. R minus E equals I, where R is simply what you take into the business. Revenue streams are commonly from products, services, and sales. Expenses are a bit tricky. Expense is taking your assets and consuming them for purpose. Common expenses are advertising, marketing, etc. Remember that production cost is also an expense. For example, when I was starting my company, we were trying to figure out the cost of production of a strawberry smoothie. We calculated the cost of each and every ingredient that we were using in the smoothie, the cost of the container, the labor costs, but we forgot to calculate the cost of electricity, which would be using to run the equipments. And these small things keep on adding up over a period of time to be too small to consider. So they have to be taken into consideration. And income statement does a good part in doing that. Here's an example of the income statement over the 3 years, calculating the cost and revenue and expenses, and at the end showing how the net income is either increasing or decreasing in this case. Here's another example of Amazon's income statement. Cash flow statement. The statement of cash flow looks at the liquidity of a company. You can break it up into operations, investments, and financial activities, where operations show the day-to-day cash flow of money. Investment shows the money acquired from or going into your investment. Financing is for when you take your company to the stock market, as buying, selling public equity. You should consider these costs over a period of time, and make necessary measures to do that. Here's an example of cash flow due to operations, cash flow due to investment, financing, and then giving your final net increase in cash. Cash flow statements show the financial health of a company. The balance sheet may show that the company has a lot of assets, but it doesn't show if the company, for example, is making its loan payments on time, or paying its customers on time. In one of the companies I worked for, AMAT, for example, the company had enough funds to pay their employees overtime and an extra 25% on their income for the risk they were taking during the pandemic. They could only do that because of a strong cash flow statement game. Here's another example of Amazon's cash flow statement. For our activity today, we'll look up the financial statement of your favorite company, try to see if you can break them down into familiar sections. Now, notice how simple the documentation feels now that you know what you know. And my suggestion would be to look at the financial statements of Asian Paints, which is a very strong company in the Indian market and very profitable company. Best of luck. Thank you.